Welcome back to The Deep Dive, the show where we take that impenetrable pile of reports, research, and technical guides that you shared with us and transform it into genuinely useful, actionable knowledge. Our goal is to make sure you walk away feeling not just informed, but equipped.
Today, we're embarking on a deep dive into what is arguably the most common yet most frequently misunderstood piece of official documentation in the modern American economy. We're talking about the IRS Form 1099.
That's right. Our source material today is this incredibly exhaustive guide covering the entire 1099 ecosystem, and I mean all of it, all 17 plus variants. Now, when most people hear 1099, they immediately picture, the freelance graphic designer, maybe the Uber driver, or the side hustle consultant.
I think gig work.
Exact gig work.
And while that is absolutely a core function of the 1099 system, it reports an astonishingly diverse range of income, financial transactions, debt cancellations, even sales proceeds.
Yeah.
It goes far beyond simple non-employee compensation.
So our mission today is pretty straightforward. We want to give you a structured, deep understanding of these forms, their filing requirements, and their hidden significance. We're going to turn what often feels like administrative dread into clarity.
The goal here is to show you why understanding the 1099 is crucial, not just for filing your taxes, but for understanding the fundamental mechanics of how wealth and payments are tracked in the U.S.
Okay, so to start, we have to establish a core definitional difference, which the source material really emphasizes is often confused, just in everyday conversation.
Yes. What exactly is a 1099 compared to, say, your 1040? They are not the same thing.
Okay, let's unpack this. A 1099 is classified by the IRS as an information return, and this is the fundamental distinction from what we call a tax return.
Right. A tax return, like the Form 1040, is the document you, the individual taxpayer, use to actually calculate your final tax liability and report your total income from all sources.
It's the final accounting.
It's the final accounting, exactly. The 1099 doesn't calculate anything for you. It simply acts as a mechanism for a third party, the payer, to inform the IRS that a payment or a transaction occurred, and that you, the payee, were the one who received that money, or those proceeds, or that benefit.
So it's just reporting income other than traditional wages, salaries, and tips.
Precisely. Those are covered by the W-2 system, which is a whole different animal.
So it's like the government's early warning system. It's a little flag that goes up telling the IRS, hey, just so you know, this taxpayer over here received X amount from us.
That's a perfect way to put it. It's an early warning system. And that information sharing mechanism is, it's the backbone of the independent economy we talk about so much today.
Yeah.
When we analyze the economic shifts of the last decade, we're constantly using phrases that come directly from these forms.
The 1099 economy.
The 1099 economy, or defining someone as a 1099 worker.
Yeah, lexicon is so essential because it instantly separates a massive class of workers from the traditional W-2 employee.
It does.
A W-2 employee gets all the benefits of the employer handling withholding, payroll taxes, Social Security, statutory benefits.
The whole 9 yards.
The whole 9 yards. The moment you become a 1099 worker, you step into a world of, greatly increased administrative and financial responsibility.
And that responsibility isn't limited just to tracking your income. It involves calculating and paying self-employment tax, which can be a real shock to people.
Oh, yeah. The first time you see that number.
It involves understanding complex deduction rules and making estimated quarterly tax payments to the IRS and state authorities. These are all things a W-2 employee rarely, if ever, has to manage directly.
So the 1099 is more than just a piece of paper. It's really a legal definition of an entire class of economic actors.
It is.
And as we mentioned, the scope of what it reports is just vast. Independent contractor payments, yes, but also interest from your savings account, dividends from stock, proceeds from selling your house.
Even debt cancellation and government benefits. It truly is the government's universal ledger for financial activity that doesn't pass through a traditional payroll system.
Which brings us directly to, I think, the most critical legal point for you, the listener. It's about the significance of the 1099 for the person receiving the money, the payee, and what it means for your tax liability.
This is a massive, massive stumbling block for so many people. High earners, freelancers, even someone just, dabbling in the side hustle world.
I see it all the time.
It is, because if there is one legal concept we need to just hammer home today, is this. The issuance, or conversely the non-issuance, of a Form 1099 is not what determines the tax treatment.
Okay, let's translate that into practical terms because that sounds a bit like legal jargon.
Fair enough.
Let's say a client pays you $500 for a service. That falls under the typical $600 reporting threshold, right?
Right.
So they never send you a 1099. That $500 is still taxable income, isn't it?
It is 100% still taxable income.
You can't just use the lack of a form as an excuse not to report the money.
No, absolutely not. The source material is unequivocal on this point. Each pay taxpayer is legally responsible for reporting the correct total amount of income on their federal income tax return, regardless of whether a Form 1099 was ever filed. The burden of accuracy rests entirely on you, the recipient.
This is so crucial for new businesses or freelancers who are maybe dealing with smaller clients, clients who might not be so diligent about their own reporting requirements.
Who don't even know they have them.
Right. So the rule is if you get paid, you track it and you report it. You cannot rely on your payer to be your accountant or your compliance department.
And this leads us to the next level, where it gets, in my opinion, really interesting. Because not only must you report all the income you receive, but the figure reported on the 1099 often does not represent your actual taxable income.
Okay, this is a sophisticated nuance that I think trips up even experienced investors and property owners.
It does.
We need to drill down into the concept of basis here, and the source material provides the perfect mechanism to explain it. The Form 1099-S.
Right. Form 1099-S reports the proceeds from real estate transactions.
Yeah.
So let's use an example. Imagine you inherited a piece of land back in 2005.
Okay.
At the time you inherited it, it was valued at, say, $50,000. And this year, you sell it for $150,000.
Good profit.
A very good profit. Now, the closing agent, the person or company responsible for preparing the 1099-S, they report $150,000 to the IRS. That's the gross sales price.
But the key here is that the person preparing that 1099-S, they don't know your history with the property. They're not required to calculate your actual gain.
They have no idea. All they report is the proceeds.
So what happens next?
Well, your true taxable gain is determined by deducting your basis from those proceeds. Basis, in this context, is typically the original cost of the property, plus any capital improvements you made.
Like adding a deck or renovating the kitchen.
Exactly. Or, in this case, since it's inherited property, the basis is the fair market value at the time you inherited it.
Which was $50,000 in our example.
Right. So the IRS receives a form saying you got $150,000. But because your basis was $50,000, your taxable capital gain is only $100,000.
And if you fail to track and report your basis correctly on your own tax return,
the IRS system would almost certainly flag your return, because their computer sees a 1099-S for $150,000, but it doesn't see that income matching up on your 1040.
And this same concept applies to investment sales, right? The ones on Form 1099-B.
Absolutely. The 1099-B tracks broker and barter exchange transactions. It reports the gross amount you received from selling a stock or another asset. You are then responsible for calculating your basis, which is, what you originally paid for it, to figure out your actual taxable gain or loss. The 1099 is just the revenue side of the ledger.
Okay, so to summarize that critical insight for you, the listener, the 1099 reports the starting number. It's the gross figure. You are responsible for providing the rest of the equation, the basis, the expenses, the deductions, to arrive at the true final taxable figure.
And if the IRS initiates an inquiry or an audit, it's often because they see that big 1099 number, but they don't see the offsetting deductions and basis calculations on your return.
It's the highest priority item for anyone dealing with capital assets. You have to track your basis
Meticulously.
So before we move on to the mechanics of filing, let's quickly touch on two little administrative points for the recipient. First, the source material mentions that payers can issue something called a combined Form 1099. What's that?
This is really just a logistical efficiency measure. It's mainly used by large financial institutions or payment platforms.
Your brokerage, maybe?
Exactly. Instead of sending you 5 separate pieces of mail for interest, dividends, broker sales, royalties, and miscellaneous payments, they can consolidate them all onto one single physical or digital document.
It saves paper for the payer, but what about the person receiving it?
Well, you still have to process each transaction according to its corresponding rules. The rules for 1099 INT still apply to the interest section of that combined form. The rules for 1099-B apply to the broker section, and so on.
That combined form idea seems like a great way to save paper, but I can see how it might create confusion on the receiving end when they go to file.
It can, absolutely.
Yeah.
If the recipient just glances at the first box without realizing there are multiple distinct income streams consolidated within that one document, they could easily miss something. It requires careful attention to detail.
And second, regarding attaching these forms to your 1040, are we required to staple all those copies to our tax return and send them to the IRS?
Generally, no. You are usually not required to physically attach any 1099 forms to your federal income tax return, especially if you're filing electronically.
Why not?
Because the IRS already has the information. The payer sends their copy directly to them. They've already received the data.
But there's a vital exception to that rule.
Yes. There is one big one. You must attach the 1099 if the form includes a report for federal income tax that was withheld by the payer from your payments.
So this is for things like backup withholding.
Exactly. Backup withholding or statutory withholding on certain types of payments. Since that withholding functions as a payment you've already made toward your final tax bill, the IRS needs that documentation attached to your return. It's how they credit you for the money that was already sent in on your behalf. It's verification of payment.
Okay, let's pivot now to the operational side of this. The filing mechanics for the business or the entity that is actually issuing these forms, the payer.
The logistics here are incredibly detailed and for good reason. The entire system relies on the payer following a very strict process.
So what's the first step?
First, the payer must complete a Form 1099 for each covered transaction, and then they're typically distributed in 4 parts.
The famous 4 copies.
The famous 4 copies. 1 copy stays with the payer for their own records. The second goes to the payee. That's you if you received the income. The third copy is filed directly with the IRS. And the fourth copy, depending on the state's requirements, is often sent to the state tax department.
So this chain of custody ensures transparency across all the relevant tax authorities.
That's the idea. And considering the millions, perhaps billions, of transactions that trigger a 1099 every single year, the method of filing becomes incredibly important.
I can imagine.
Absolutely. The IRS has a logistical mandate here. Any payer who files 250 or more Form 1099 reports in a year, they must file all of them electronically with the IRS.
250, so that's the magic number.
That's the threshold. It exists because trying to process paper returns on that massive scale is just, well, it's inefficient and it's extremely prone to error. Electronic filing is mandatory above that 250 form limit.
But what about the small businesses? You know, the local contractor who only paid 3 other freelancers, or the lawyer who paid out 5 small settlement fees during the year?
If the payer falls under that 250 report threshold, they have the option to file paper copies.
And if they choose paper, they have to do something extra.
Yes, if they choose paper, they must also submit a form called Form 1096.
Form 1096, what is that?
It's essentially a cover sheet. It's a summary or a transmittal form that totals up the number of paper 1099s being sent in that batch and the total dollar amount of income being reported across all those forms.
So Form 1096 is the paper summary for the whole batch.
Right.
But it's completely unnecessary if you file electronically because the electronic system provides all that summary data automatically.
Precisely. It's an artifact of the paper-based system that ensures the IRS knows how many forms to expect in that specific envelope.
Now we get to maybe the most well-known and also the most frequently misinterpreted rule in this entire system.
The dollar thresholds.
The dollar thresholds. When is a payer actually required to issue a 1099?
The famous $600 rule.
And we need to be very, very clear about where that $600 applies and where it absolutely does not, because it's so often a trap.
That's right. The general threshold that's cited for many of the variants, particularly 1099 NEC for non-employee compensation and in 1099 MISC for miscellaneous income, is $600.
Okay.
If a business pays an independent contractor $600 or more for services rendered during the calendar year, they must submit a 1099.
And if they paid them $599.99?
No form is legally required from the payer. But, as we've already covered, the income is still taxable to the recipient.
Okay, but wait. If the rule is $600 for services, why would the IRS bother tracking a $10 royalty, which is the threshold for 1099 MISC royalties, or $10 for 1099 INT interest income? That seems like regulatory overkill for such a minimal amount. What problem are they trying to solve with that?
That's a fantastic question, and it really points to the difference between tracking payments for services versus tracking passive or semi-passive capital income.
Okay, explain that.
The $600 threshold for services is rooted in administrative practicality, the cost of compliance for a small business versus the revenue the government would gain.
Yeah.
But for passive income streams like interest and royalties, the transaction volume is usually incredibly high and often handled by large, centralized institutions.
Like banks or publishing houses.
Exactly. The administrative cost for them to track and report these small amounts is very low because it's all automated.
I see.
And more importantly, passive income streams, such as interest, can accumulate very rapidly, especially if a taxpayer has accounts at multiple institutions. Tracking that $10 threshold across 50 different sources is a much easier way for the IRS to build a complete picture of someone's income.
So it helps prevent high net worth individuals from, let's say, conveniently forgetting about all those small dollar interest streams that can quickly add up to a significant amount.
That's the idea. It puts the low threshold in context.
Now, let's revisit that $600 service payment requirement because there's a critical exception to it.
Yes, the corporate exemption. This is a big one. The source material notes that the $600 requirement usually does not apply to payments that are made to corporations.
So if my small business pays a large software corporation $50,000 for licensing fees, I do not have to issue them a 1099 NEC.
That's correct.
Why the carve-out for corporations?
Well, the assumption from the IRS is that larger incorporated entities, because of all the regulatory requirements and auditing standards they're subject to, already have very robust internal accounting systems.
So the risk of them underreporting their income is considered lower.
Generally, yes. Lower for a C Corp than it is for a sole proprietor or small individual contractor.
Right.
Therefore, requiring a 1099 for every single corporate payment would add an immense administrative burden for businesses without a commensurate return in enforcement and tracking.
It's a practical regulatory distinction based on the presumed rigor of the payee's own accounting.
That's a great way to put it. Yeah. Now, moving beyond the dollar thresholds, the final mechanical rule here concerns the timeline. The deadlines are strict.
So when must these forms be filed with the IRS and, just as importantly, sent to the payees?
The general deadline is January 31st of the year, immediately following the year the income was paid.
So for 2024 income, forms must be in the hands of the recipients by January 31st, 2025.
Correct. And that allows the payee enough time to prepare their own tax returns before the April deadline.
And regardless of the payer's own fiscal planning, if they run on a different fiscal year, the reporting period is fixed.
Absolutely. This is what's called the calendar year mandate. Forms 1099 track income strictly from January 1st through December 31st. This remains true even if the payer or the payee operates on a non-standard fiscal year for their own accounting purposes.
It provides a universal standardized window for all this information sharing.
It does. Now let's quickly reiterate the filing deadlines for the payer sending the forms to the IRS because they have a slight extension depending on their method. For paper filing, the deadline to get the forms to the IRS is the last day of February. However, if the payer is filing electronically, which remember they must do if they issue 250 or more forms, that deadline is extended to March 34.
And that extra month is a significant logistical window for large organizations.
A huge window. It gives them time to reconcile data across massive, complex payment systems.
Okay, now we move into the vast, complex world of the 1099 variants. The source material lists over 17 specific versions. We can't cover them all in exhaustive detail, but we have to focus on the most important thematic groupings. Let's start with the ones at the heart of the 1099 economy.
Good idea. Let's group these. We'll start with services and digital platforms, which probably impact the majority of our listeners who freelance or run small businesses.
First, the twin pillars, 1099 NEC non-employee compensation and 1099 MISC miscellaneous income.
The 1099 NEC is the primary form for services paid to independent contractors. It uses that $600 minimum threshold we've been talking about.
And its return in 2020 was a major administrative event.
It really was. This compensation was previously reported on Form 1099 MISC from 1983 all the way through 2019. The IRS separated them again to streamline the tracking of self-employment income.
Because that income is subject to different taxes and filing schedules, like the Schedule C.
Exactly. The split was about making the self-employment tax clearer for the IRS to track. It allows them to match payments for services directly to self-employment tax liabilities.
So what's left on the 1099 MISC now?
It remains for pretty much everything else. Rents, prizes, awards, certain medical and healthcare payments, and, as we mentioned, royalties, which only have that tiny $10 minimum.
So if you own a rental property, the payments you receive might trigger a 1099 MISC from the property management company.
Correct.
Okay, next. The form that has caused the most recent legislative and political turbulence, 1099-K merchant card and third-party network payments.
This form is a direct reflection of our digital economy. It's issued by payment processors like Venmo, PayPal, Square, or platforms like Etsy or eBay. It tracks the gross value of transactions processed through those networks for goods and services.
And this form is a perfect example of why our basis discussion from earlier is so important.
Yeah,
A micro business might sell, say, $10,000 worth of vintage goods on Etsy. That triggers a 1099K for $10,000.
but if they spent $8,000 acquiring and refurbishing those goods, their actual profit is only $2,000.
Right. The 1099K tells the IRS 10,000, and the taxpayer must then prove their $8,000 in basis or cost of goods sold.
The legislative history here is just, well, it's volatile. Our source material notes that the federal threshold has been debated fiercely. The IRS's long-term goal was to drop the threshold down to $600 with no transaction minimum.
That created a massive backlash.
A huge backlash from casual sellers on online platforms. So the source material, reflecting the latest statutory adjustments, notes a specific threshold of $2,500 for the 2025 tax year.
And after that, the threshold is slated to drop further, potentially to $2,000 for the 2026 tax year, with adjustments for inflation after that.
The takeaway for you is that this reporting net is continually widening, and the rules are changing rapidly in response to the massive volume of digital transactions. The 1099K is the IRS's way of keeping pace, but it places an immense record-keeping burden on the casual seller.
Okay, let's move into our second group, the investment and capital suite. What's fascinating here is how many of these forms deal with passive income or trading activity.
We can start with the most common passive income forms, 1099 INT, interest income, and 1099 DIV, dividends and distributions.
Both have that standard $10 minimum threshold.
They do. And they're issued by banks, financial institutions, or brokerage firms. Again, even the smallest amount of interest or dividends is tracked because these large institutions can automate the process so easily.
Now, for 1099 DIV, the threshold jumps to $600 for certain things.
It does, if the distribution is specifically a liquidation or what's called a payment in lieu of dividends. This separates routine passive income from major capital events relating to the winding down of an asset.
Then there's the crucial form for active investors. N99B, proceeds from broker and barter exchange transactions.
This form is unique because it uses an any amount minimum threshold. It's issued by your broker, and because capital gains and losses are calculated based on that difference between basis and proceeds, the IRS requires reporting on the proceeds regardless of the dollar amount.
This ensures every single stock, bond, or asset sale is accounted for.
Every single one. And then quickly, there are two specialized forms here. 1099 OID, original issue discount, for debt instruments issued at a discount where interest is sort of imputed over time. That's a $10 minimum.
And that truly outlier form, 1099 CAP.
Yes, the 1099 CAP reports changes in corporate control and capital structure. This is issued by the corporation itself, and the threshold is just massive, $100 million.
$100 million.
So if you are getting one of these, you are having a very, very different kind of tax year than the average listener. It's for tracking high-level mergers, acquisitions, and recapitalizations that affect major shareholders.
We can safely say that if you're filing a 1099 CAP, you have professional tax advice, and you're probably not relying on this deep dive for your final filing strategy.
That's a fair assessment.
All right, let's move to our third category, the debt forgiveness duo and property transactions. These forms track financial events that aren't strictly income for services, but they dramatically affect your balance sheet.
And the first one is often a very unwelcome surprise for people. 1099-C, cancellation of debt.
Explain this one.
If a lender forgives a debt, say a credit card company settles with you for less than you owe, or a lender reduces your loan principal, that forgiven amount is typically considered taxable income.
Why?
Because it represents a clear increase in your net worth. You're better off financially than you were before the debt was forgiven. The threshold for issuing a 1099-C is a $600 minimum.
But there's a truly humane and critical exception built into tax law regarding student loans, which the source material specifically mentions.
This is a very important distinction related to the Tax Cuts and Jobs Act of 2017. The IRS specifically instructed lenders not to issue a Form 1099-C when a student loan is discharged because of the borrower's death or permanent disability.
That prevents the estate, or the disabled individual, from incurring a substantial and unexpected tax liability,
which would fundamentally undermine the entire intent of the loan discharge. It shows the tax system making nuanced adjustments in specific hardship cases.
Related to debt, we have 1099-A, acquisition or abandonment of secured property.
This one is issued by the lender for any amount. This form notifies the IRS that a secured property, like a house that's under foreclosure, was either acquired by the lender or formally abandoned by the borrower.
So it's a tracking trigger.
It's a trigger that ensures any resulting capital gain or any debt relief income is addressed by the taxpayer on their return.
And of course, the 1099-S proceeds from real estate transactions, which we used earlier to illustrate the concept of basis. That has a $600 minimum.
And it's issued by the closing agent or whoever is responsible for the transaction. This form is the government's primary signal that a major asset transfer has occurred.
Okay, finally, let's look at our last thematic group, government health and benefits. These forms show how the 1099 system is used to track the social safety net and other specialized government transactions.
If we connect this to the bigger picture, you can really see the government tracking its own expenditures and payments to determine their taxability.
First up is 1099-G, government payments. This one is key for tracking things like unemployment compensation.
Which is taxable.
Right. And also state or local income tax refunds or agricultural subsidies. The minimum threshold is $10 and it's issued by a government agency.
For health and education, we have several forms that report distributions. 1099 LTC, long-term care benefits, and 1099-H, health insurance advance payments. Both of these report any amount.
Why are those necessary?
They're necessary to track the taxable portion of certain insurance payouts and also for the reconciliation of Affordable Care Act subsidies.
And for parents saving for college, there's the 1099-Q qualified education programs.
This reports any amount that is distributed from a 529 plan or a Coverdell ESA. And while the distributions are often tax-free if you use them for qualified education expenses, the distribution itself must still be reported to the IRS.
So they can verify its proper use.
So they can verify its use, exactly.
Lastly, the specialized government statements. The SSA 1099 for Social Security and the RRB 1099 for railroad retirement benefits.
These both report any amount.
And as we noted earlier in the show, these forms uniquely list NA for the IRS due date.
And that's because the Social Security Administration is the government entity. They generate the data internally and send the statement to the recipient. There is no separate filing requirement with the IRS because the IRS is already the ultimate repository of that data.
We've thoroughly decoded the current system, but to truly understand the scope and the persistence of the 1099, I think we need to understand its origins. Let's step back in time a little.
Understanding the history of information reporting is fascinating because it's so deeply rooted in the government's need for massive wartime revenue.
The system didn't start with the W-2 as we know it. It started with this 1099-style structure. Where does the origin point lie?
The requirement began with the War Revenue Act of 1917. This was a pivotal moment in American tax history, enacted shortly after the U.S. entered World War I. The government needed to rapidly fund the war effort, and so it significantly expanded the income tax base.
What was the initial scope of that reporting requirement back in 1917? Was it already targeting this kind of non-wage income?
It was surprisingly comprehensive from the get-go. It was designed to capture virtually any type of fixed payment that wasn't strictly salary withholding. The act required entities to report payments of interest, rent, salaries, wages, premiums, annuities, compensation, remuneration, emoluments, or other fixed or determinable gains, profits, and income.
That's a mouthful.
It is. But the message was clear. If a stream of income was consistent and trackable, they wanted to know about it.
And the original threshold was actually higher than today's famous $600 rule.
Much higher, in real terms.
Yeah.
Payments were required to be reported if they totaled at least $800 during the year.
$800 in 1917 was a significant sum of money.
It was. To put that in perspective, $800 in 1917 would have the purchasing power of roughly $19,000 today. So the original reporting requirement was aimed squarely at large payments, not the small-scale service payments we track today.
So the goal wasn't to track every small transaction, but to ensure that high-value fixed payments were known to the tax collectors, especially as income tax rates were rising dramatically during the war.
Exactly. The payer had to report the payee's name, address, and the total amount paid on Form 1099 and file it by March 1st of the following year. This was pure information sharing to enable enforcement.
And the original Form 1096 had a much weightier role back then, didn't it?
It really did. The payer wasn't just sending in a summary sheet like they do today. They were required to include Form 1096, which served as a letter of transmittal and as an affidavit certifying the accuracy of each Form 1099.
An affidavit, so they had to swear to it.
They did. That affidavit requirement underscored the legal gravity of providing this information and ensured that the payer took direct responsibility for the integrity of the data.
That certification process speaks volumes about the historical seriousness of this data. It's moved from a sworn affidavit to a simple electronic upload, but the underlying legal responsibility remains the same.
And the system has constantly been updated to keep pace with economic changes. We've seen legislative extensions, like the Small Business Jobs Act of 2010.
Right. That act extended the 1099 reporting requirement specifically to include payments made by people who receive income from rental property.
This was a direct response to the growth of the small-scale rental market, people renting out a second home. It ensured that revenue streams from landlords, who were essentially independent contractors providing a housing service, were being reported accurately.
It just expanded the net of the 1099 MISC.
It did. And as we covered pretty extensively, the constant recalibration of the 1099K threshold shows the system's continuing evolution, trying to capture the digital dollar.
The motivation behind the 2020 split between the 1099 NEC and the 1099 MISC is another great example of this evolution.
It is. Before that split, the filing deadlines for 1099 MISC varied, which caused major headaches for the IRS in matching service payments, which require estimated tax payments against passive income like rent.
So by bringing back the dedicated 1099 NEC, the IRS clearly tagged those service payments.
Yes, which simplified their enforcement of self-employment tax rules. The entire system is this continuous regulatory feedback loop, constantly adjusting its dollar thresholds and its form structures to address where the money is flowing in the modern economy.
This has been a truly comprehensive deep dive. We've moved far beyond the simple definition of a freelancer form. We've established the complexity of information reporting versus tax liability.
Let's review the critical takeaways. If you are a 1099 recipient, the first and most important nugget is that difference between proceeds and basis, particularly with the 1099-S for real estate and the 1099-B for investments.
The form only reports the gross proceeds, the cash you receive from a sale or transaction.
Right. But you, the taxpayer, must prove the true taxable gain or loss by meticulously tracking and documenting your basis.
Second, always remember your ultimate responsibility. The issuance or lack thereof of a 1099 does not determine if income is taxable.
Every single dollar you receive, regardless of the payer's compliance with the thresholds, must be reported accurately on your tax return. Never, ever rely on the payer to be your compliance system.
And third, appreciate the sheer scope of this system. The 1099 isn't just about the gig economy, it's the government's comprehensive net for tracking financial activity.
It covers everything from interest income and corporate capital changes to debt forgiveness and health benefits. It is the universal language of non-wage transactions.
This raises an important question. We have seen the government's tracking capabilities intensify, especially with that volatile 1099K net expanding to capture nearly all digital commerce.
Which means the IRS will increasingly have instant access to the gross income figure for millions and millions of transactions.
Given that dynamic where the IRS knows the revenue side of the ledger almost instantaneously, how does that fundamentally change the taxpayer's relationship with tax compliance?
Well, if the IRS already knows the gross numbers through the 1099K, the 1099-S, and the 1099-B, the future of tax scrutiny isn't about proving that you received income. They already know you did.
The future is about proving your deductions.
Exactly. This means your single most important action moving forward isn't tracking your payments. It's meticulously tracking and documenting your basis, your expenses, and your exemptions to justify the difference between that 1099 gross number and the taxable net income you ultimately report.
The administrative game is shifting entirely from proving what you earned to proving what you spent. That's something to think about as you reconcile your finances this year.
Indeed. It transforms record-keeping from what feels like a necessary evil into a critical element of your financial defense.
A perfect place to leave our deep dive. Thank you for joining us for this extensive look into the Form 1099. We hope you feel far more prepared for tax season than you were an hour ago.
Until next time, keep digging.